Yeah, so like Professor Florescu said, I've been working at a commodity trading firm for the last 8 months now. Been actually trading hands-on for the last 6 months-ish. So coming from the Shift team and working with Shift, it's pretty interesting to see a lot of the industry quirks that I was completely unprepared for. So today, yeah, I'll go through kind of what I do on a daily basis and just kind of compare and contrast between what I assumed markets looked like uniformly in Shift versus what I realize happens, at least in my markets, on two completely opposite ends of the spectrum. So just a little background, like Professor Florescu said, I worked on Shift and the high-frequency trading competition last year. I did a lot of the plumbing behind the scenes stuff. I worked on the automated market maker research group. That's what I did my master's thesis in. Kind of just how can you provide liquidity at all times continuously. And so just a general theme of what I gathered through school in all my classes was that we just kind of assume continuous liquidity, and we assume a lot of not fictional, but idealized facts about the market. And when I started working, a lot of these just kind of broke down. And I heard that you guys are doing a small cap competition theme this week, so I think this fits in pretty perfectly with what you might see kind of to a lesser extent. And so now I am trading power. These are power futures. Specifically, my products are PJM zonal basis futures, which I'll explain in a second. But the main theme here is it's entirely broker-driven. There is no liquidity on intercontinental exchange. There is just talking to brokers, and it's very illiquid as a fact. So the same underlying problem everywhere, just trying to find an edge, but how you get there is completely different. Just some quick structure. I don't want to bore anybody, but in America, you have thousands and thousands of nodes. Each one of these nodes has a corresponding price. You can aggregate these into zones or hubs, and the futures definitions are monthly averages of these averages of single nodes across the US in specific regions. So what I trade is basis. I trade zones minus hubs. And this is for the kind of eastern coast of the US, everything above Virginia and below New York. That's where a lot of the liquidity is. And I say liquidity as in more than the other products that don't trade at all. So like I said, we actually trade futures, which are monthly averages. There's different definitions. So for one product, there could be up to 4 right now different definitions of how that product is settled. Which is the peak hours and the off-peak hours, which have different profiles, so different people might want different things. And then I trade futures, so this is a forward curve and extends up to around 2032 is when nobody quotes further, further from, but that's kind of what I'm working with. And so in practice, what actually happens.
Futures up to 2030?
Yeah, so it's actually cool because it's every single month. So what is that, 5 years, 60 months, even more than that? And then, as I'll get to here, a lot of those months, individual months later on, don't actually trade. What trades are strips and spreads. And so you have this exponentially large, universe of technically available products. It's just in practice that doesn't actually happen that much. So like I said, we have brokers. These are inter-dealer brokers. That means they just match clients together. So they basically find a counterparty for me to trade against. It's still exchange cleared. And so prices are communicated via broker screen, which is kind of like a fake exchange. Screen, voice, and chat. Voice isn't they call me and they tell me to execute. It's more like a voice chat you have on Discord where I push a button and I'm talking to somebody. So but the most like common method of communication is just texting somebody, like chatting. We use Ice Chat, and so that's what this that's what this screenshot is at the bottom. But yeah, these brokers, they see flow from everybody. They know more than any single participant. They can get you better prices. They can use your information against you. Like the order book, and what I mean by trading without an order book is that it's really just a web of people with different markets that me as the participant has to piece together in real time and kind of form this like mental order book. And so, yeah, at the bottom, I got permission from my boss, but I censored the broker names. I don't know, just in case compliance is going to come after me. But this is what like a typical kind of day looks like. I get quotes pretty frequently. Today was a bit busier, but what you get are like these shorthands, and you take some time to decipher them. This one's kind of obvious, Q4'26, so this is the average of the 3 months of Q4 in the year 2026. This is the location, this is the spread it's to, so West is West Hub, which is the most liquid power product in probably the US. This is the schedule. That means all hours around the clock, 7 days a week. And this is the bid and the offer. And just a side note, for some reason, maybe it's just futures, but nobody says ask. It's never bid and ask. It's always bid and offer, which is kind of funny. But so this is bid and the offer, different products. This is a planning year, so it's 12 months, but it starts in June. This indicates a different year. This is peak, so it's only hours 8 through 23, which is around 11 p.m. And so what I mean by, again, this mental image of the order book is that I have a place where you can see all of this at once, but when you see these sequentially, you kind of form your thoughts and opinions on what's happening in the market. And so you see, one guy improved. Yeah, you see this quote right here. It's a planning year 6-7 BGE ATC at 1310. And that was kind of quoted really early in the market at like 1325. And throughout the day, nobody bid on that market, right? So it was just one-sided all day. And you can see them decrease, and then slowly you can kind of form an opinion on what's going on in the market based on the relationships you know and what brokers tell you individually. And so you could probably maybe assume from this that nobody wants that, maybe that price is too high, maybe nobody's willing to take that on right now for a reason, and you can kind of trade around it, and that's where a lot of your signal actually comes from. But just stepping back, core comparison, idealized facts, you have high-frequency trading. There is always an order book with quotes on both sides, and it's easy to kind of see, imbalance or big orders within there. There's some caveats like iceberg orders, but in general, the price is always known. Again, idealized fact, there's many ways to actually kind of say what a price is, but it's always there. That's a fact at time t that it traded, and it's a known fact. Exit is usually available, as in when you want to get out of a strategy, you usually can, assuming some costs. And then the signal really comes from the order flow that you have around you, the microstructure of the market itself. I mean, that's what like those big HFT shops were prolific for before, what was it, Dodd-Frank? And then you have like cross-asset. You have a lot of these different contracts that have the same characteristics, and you have a lot of data to work with of the prices themselves. In power, prices are often unobservable. Like I said, there's 60 plus months that I can technically trade. Out of all of those possible combinations, 99% don't trade, and sometimes there's locations that don't trade at all for a month. And what do you do then? Well, you have to kind of guesstimate your way to what a fair value is. And so there's also these little quirks, like discovery is not always a given. In the markets, you usually see news breakout, big rally, correction, like steady state, right? But here, That might not happen at all. It's just trading one day, like 10 at 11. The next day, some big news breaks out. It's at 13, 14. There was no intermediate steps there. And it still might not even trade. Exit opportunities may not exist at all. You get days where something's moving against you and you're only hurting yourself by just pushing deeper and deeper into whatever is hurting you or your positions. And so the signal is a lot of fundamentals. Kind of a cool comparison is that, like, although we don't have these prices for my monthly futures, there's not a lot of liquidity there. Those underlying power grid, like the power grid data, is immense. You have those 10,000 nodes, 14,000 nodes, all with hourly prices, technically 2 prices per each hour. You have generator data, you have weather data, you have all of these things that come together and give you a very, very robust, like, spot market analytic library to work with. And the spot markets are very liquid, but it doesn't translate as well into what I trade. Signal's also positioning, knowing who's in the market and when, and kind of the relationships you form with your brokers. They can give you a lot of insight on what's going on, and you can use that to your advantage.
I have a side note just
Yeah.
to complete this thing, the picture that you're giving. So we have here PSENG. PSENG is right next to us.
Yeah, we're in it.
Yeah, so we have it's within you.
within Hoboken,
within
and it goes
Hoboken.
down. Yeah.
So basically, what I was going to share here is that we had the entire PSENG trading team come to us and be basically sitting at this table. Huge number of people, and all they are doing, they're trading spot and 1 day future.
Yeah.
1 day. That's the entire, so there's like, I don't know, 15 people, they're making tons of money they actually produce the energy, and their problem is really simple. Their problem is, should I trade everything today, or should I leave it for trading tomorrow? That's it. That's all they're doing. So when you're saying you're trading, like, years and years down the line, that's really, very discordant to what PSENG main business is.
Yeah. So yeah, that spot market, super liquid. They're probably really smart. It takes a lot of, like, data and modeling to know that, and especially in recent years when there's been, like, a real focus on storage optionality and when to actually produce things, not just sitting in a fixed contract. So that's really cool stuff. But my company does not do that. That's not where our edge lies. So we're allowed to trade that, but we don't for some obvious reasons. But yeah, the first kind of picture I want to paint is this liquidity and exit risk. I've kind of already gone over it just a touch, but exiting a position in the competition, at least, is usually pretty possible. It's not a question of whether you want to exit, it's a question of when you want to exit. And it's completely contrasted by what I trade, where I have to think about what is my chance of actually getting out of this thing before I even enter it. And I have to think about who is on the other side. There's a bunch of different flows coming through, and you have to just kind of estimate when you can get out of it, what's your overall risk, and it kind of becomes a function of, or your position sizing becomes a function of these factors, because you're not going to slam 50 megawatts or 100 megawatts into some random month in 5 years just because it's well offered. That might go against you massively, and you'll have no opportunity to get out of it. So what this actually looks like is that bids and offers that I see on a day-to-day basis, there's kind of a give and take. They're not always firm. They might be scattered around. And then, again, like I said, markets might just gap without a single print, and sometimes there's nothing you can do about it unless you're super early or somebody puts up a stupid bid or a stupid offer, and you can just kind of get out of things quickly. But that goes into the next thing, is reading the market. Kind of the core idea here is, I feel like in high frequency trading, especially what you guys are doing in the competition, it's really cold. it's just numbers on a screen. And although it is numbers on a screen for me as well, it's there's kind of a lot of like story and behavioral economics behind the things I'm seeing on a day-to-day basis. When I see a market that looks off, I think about who's actually behind that order, and that does transfer to an order book that you might see in like the equities markets, but kind of on a bigger note because it's a little bit more consequential for me when I take something that I can't get out of. So when there's just a random offer on like a faraway bullet, I can kind of think, this is probably a generator that needs to hedge their power, and they probably have a lot of size behind it. And if I just take 25 megawatts, they're going to run me over with the 200 they have to do in total. And so you'll see a lot of these really good offers or really good bids later in the kind of forward curve that nobody actually interacts with because they know the risk that they're getting themselves into. They're going to immediately get stepped over because nobody's trading 200 megs of like one single month besides people who actually have physical assets behind themselves. There's also kind of brokers giving you, it's called color when they give you insight. And when something is bid or offered really well, broker might say they're just trying to clean up their positions. And what that means is they're probably going to pay a little bit premium to just get out of something. And you can use that obviously to your advantage because if there's something else in the market you can work it against, that's just something you can immediately close out and kind of take profit on. And yeah, like the risk of reading the market wrong is that they have more to do than you thought. Kind of extends to things like iceberg orders in the market too. You might think in a small cap day, there's only 5 lots on the bid, and you might take it expecting market to follow you, but that 5 lots keeps appearing over and over again, and you're realizing you're just hitting some person's iceberg order and that they have huge size behind them. And the risk is then you can't take on any more, and they have more to do, and they just keep going up. And then, yeah, so that's why, and again, in equity, you can get out of this. For me, it's a little bit more harsh. And then, yeah, just in general, your view sometimes doesn't matter, and this is very applicable. You might think fair value is somewhere, you might know it's somewhere, but in the end it doesn't really matter because you might just get stopped out way before then. And so you have to be wary of these things, and you have to really put on your like trader instincts and kind of think, well, okay, I know there's edge here, but I can't shoulder like this massive drop right now, so I just need to get out of it and let it go. Kind of like you need to have good discipline with those things. Especially recently, I think I might have this on the next slide. Yeah, I'll talk about it in general, risk management. There's times where I'm thinking more so as a trader, where I actually want to take edge, and more so where I'm a risk manager and I just don't want to blow up my portfolio. So when it gets extreme, the winter storm of this year, the war, gas constraints, a lot of these things have pretty huge impacts immediately across the curve. And in a sense, I might be right that, May settles as the monthly average at $10 under West Hub. But if somebody, and let's say I'm long this, but if somebody sees kind of congestion going crazy, they might smash May down $10, which if I have size on it is a couple $100,000, and I can't do anything with that, and I might just forgo my losses because people get stopped out all the time. So that's something to consider, that being right doesn't really help you if you can't actually hold on to what you believe in. And then kind of a shift, the last thing I wanted to talk about was just in general, more so on the technical side. I mentioned I did QF and FTA, so I was very much involved with the actual modeling process, and now I'm at a job where that kind of takes less of priority when things get hectic and I need to really be in the moment. But a big thing to consider is dealing with noisy data. And you might deal with this too for this week when bid-ask spreads for equity markets get a lot wider, and you might not know where a specific fair value is and if the mid is really reliable to use in a sense. So for me, marks are really noisy. Just because a broker has a market somewhere doesn't mean what my mark is even in that, that spread. I might have something outside because I know one guy on a single side is really desperate to get out of something and he's just doing whatever he can to get out of something. So marks are noisy. They're not representative of where things actually clear or trade, and any model that you build on top of that kind of inherits that. So think about that when you're training models for this week. Just because the mid is somewhere doesn't mean that's what the price you can get when you're trying to enter or exit is. That's a lot of like the cost modeling that I think is really important for backtests comes into play. For equity, for me, it's kind of harder to just in general backtest a certain strategy because I'm not 100% certain what kind of flow is going to be around in the future when I'm actually trying to execute a strategy. So what models actually do for me, very simply put, just flagging what's normal and what's unnormal. And I can see that and I can gather that data pretty easily in multitudes of ways, however I want to do it. But basically the model flags the anomaly. I have to figure out at this moment, is that in my budget to do like as a signal, as in, can I get in, can I get out? Is there still edge after the round trip? And so even when my model says, okay, that's it, the edge is done, get out, I don't know, can I? So again, for you guys, it's a little bit simpler, but I think simpler in a way of entering and exiting. But just make sure you're not giving yourself false hope by not including costs and the frictions of trading before you go put all your eggs in one basket on a certain strategy and you figure out it's not profitable. But that's the bulk of what I wanted to talk about. I hope, if anything, this gave you kind of an insight on the more illiquid side of trading, which is a large part of it. There's still a lot of contracts that are OTC and they don't trade often. I wouldn't say I'm the most illiquid by any means. On a given day, there's probably like 50 to 100 things trading, which compared to equity is pretty small numbers, but it's just a different perspective. And so I also hope that kind of helps with this week and thinking about, in general, risk management and not just trading, trade in, trade out.